Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. I'm Tim Stenovec in New York. Coming up, tech stocks on a roller coaster this morning, but pushing higher now as Iran's deputy foreign minister announced the country is drafting a protocol with neighboring Oman to oversee traffic through the Strait of Hormuz. Plus, Tesla posts one of its worst quarters for sales in years, disappointing Wall Street. We're going to have the details. And NASA's Artemis II successfully launched. We'll discuss what's next for the crew of 4 astronauts in Earth orbit right now. Well, let's take a quick look at markets. U.S. tech stocks, they are just whipsawing this morning as well. Oil prices are climbing. Bitcoin and really cryptocurrencies across the board taking a hit. Stocks moved off their lows this after Iran's deputy foreign minister announced the country is drafting a protocol with neighboring Oman to really oversee traffic through the Strait of Hormuz. This all comes after a speech from President Trump last night did little to assure investors that the war in the Middle East was coming to a swift resolution. Take a listen.
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong.
Let's first go now to Washington, where we find Bloomberg's Washington correspondent, Tyler Kendall. She joins us now. Tyler, it seems like at least the most recent market reaction notwithstanding, the market really wanted more from President Trump about a swift end to this conflict. Did we get anything new last night?
Well, Tim, President Trump really touted tactical successes so far in the military operation, but he didn't provide new information about a timeline or how the U.S. is going to address some of these strategic setbacks, mainly the Strait of Hormuz. Instead, we heard President Trump reiterate what we've heard before, including that pressure on allies to lead the way in reopening the critical waterway, as the United Kingdom today convened the foreign ministers of 35 countries to discuss the issue. But we heard from the French President Macron, for example, saying that he thinks it is, quote, unrealistic that military assets would be committed in order to reopen the strait. The prevailing sense seems to be that these assets aren't going to go to help reopen the Strait of Hormuz until there is a cease in the hostilities. Now, President Trump did maintain that the U.S. is getting close to achieving its objectives in this war, but he also previewed that we could soon see an escalation as he reiterated threats that we could have the U.S. attack Iranian energy infrastructure. That tracks with reporting from Bloomberg News yesterday that the Vice President J.D. Vance did convey through intermediaries that there is going to be this increase in threats on Iranian strategic assets until a deal is reached. Tim, at this point, the White House maintains that it is still negotiating with Iran, that these negotiations are ongoing, though at least publicly, Iran has denied that it's engaged in formal talks with the U.S.
Bloomberg's Tyler Kendall at the White House. Thanks so much, Tyler. Well, let's take a look at the market reaction now. Bloomberg tech equity reporter Ryan Vostelica joins us with more. Ryan, the NASDAQ 100 was down more than 2% earlier in the session, down only about 0.75% right now. There was a swift turnaround just in the last half hour or so. What can you tell us about this whipsawed market?
Well, what I would say is that this really shows how much stocks, especially tech stocks, have been so highly correlated to any of the latest headlines that come out surrounding geopolitical tensions with Iran. There's still a lot of uncertainty right now, and just having this geopolitical issue just augments some of the other concerns people have right now about tech valuations, about the state of AI, about the outlook for AI spending, AI disruption. All those things is what investors were focused on prior to the war, and now you have this new element that's coming in that is really overshadowing everything else.
Yeah, I think the question a lot of investors have is like, how long does this overshadow those fundamental questions that you mentioned, Ryan? Because there is a connection when it comes to higher energy prices and then, well, perhaps higher inflation for a longer period of time, and then valuations for these tech firms.
Yeah, absolutely. And the longer we have this sort of uncertainty, the longer the strait is closed, the more questions we have about that, the harder it is to sort of suss out what valuation should be, what fundamentals really look like right now, especially if you're looking at sort of the hardware space and chip makers, which have which count helium as a major component that is built into their products. If you have uncertainty about supply for that, all these other kinds of questions just right now, just like I said, add to the growing level of uncertainty about what the outlook is overall.
Love that we're talking helium right now. Bloomberg's Ryan Vostelica Always great with an update. Thanks, Ryan. Appreciate it. Well, coming up, Tesla deliveries, they disappoint, and Tesla shares are lower. More on the EV maker next, as Tesla down 3.7% right now. This is Bloomberg Tech. Shares of Tesla under pressure this morning, down about 3.7%. The EV maker posting one of its worst sales quarters in years, delivering 358,000 vehicles. Wall Street had anticipated 372,000. For more, we go back to Bloomberg's global business editor, Craig Trudell, with the details. Craig, you did a great job setting us up for this print yesterday when we spoke to you. And we talked about how the idea that even though a lot of analysts value this company not necessarily as a company that sells cars, cars are still really important. So a disappointing quarter when it comes to, or a disappointing month when it comes to sales, that still has an effect on Tesla's business, even if it has big ambitions beyond autos.
Yeah, I mean, this is still what pays the bills, right? Everyone is excited about robo-taxis. They're excited about humanoid robots, but those are still really concepts. And we don't have a robot, actually, that Tesla is selling. And it doesn't sound like they're particularly close if you're following Musk's, sort of daily missives on X. The expectations here weren't all that high, and they were trending lower. And so to see them miss by a fairly substantial margin is a big disappointment. And when you compare what some of the peak quarters have been for Tesla, where they've come close a couple of times to 500,000 vehicles in a quarter, this is a really big letdown relative to those sort of loftier levels.
The company facing a lot of headwinds here in the U.S. regarding EV tax credits and policy changes, and not excitement from this White House when it comes to EVs, but also challenges outside the U.S. where Elon Musk is not viewed necessarily favorably, and with growing competition from China. How does Tesla turn itself around before it gets to that point where it doesn't rely on autos to generate cash?
Yeah, it's a really good question. I mean, I think there is some hope that this Cybercab that is supposed to start production this quarter will be helpful in that it at least is a new product. I think this is a company that has a bit of a tired lineup. They've changed over the Model 3 and Model Y, but they're not all that different from the way they looked when they first came out. And so this two-door smaller car could be interesting to people, but is it actually ready to be put on roads without a steering wheel or pedals? I think a lot of regulators are going to have some doubts given the challenges that the company has had with what it markets as full self-driving. And so there are, again, all of these hopes as well that the humanoid robot business has a lot of promise. But this is still very much a case of a prove it in terms of whether or not that's actually going to be a business that analysts can sort of wrap their heads around anytime soon.
Bloomberg's Craig Trudell from London. Craig, thanks so much. Well, let's stay on Tesla. Ben Callow is Baird's senior research analyst. He joins us now for more. Ben, you've got an outperform rating on the stock. A new price target, though, of $538 per share. That's down from $548 per share. That's a far cry from where Tesla is right now at $367. How does it get there in the next 12 months?
Well, thanks for having me on. It was a great commentary that you guys just had about the vehicle miss, and numbers did come in. I think more importantly on the miss was on the energy side of the business. And as Craig said, what pays the bills is auto sales and battery sales for energy, and so that was disappointing, more disappointing than the auto miss. And with CapEx and their capital expenditures, with all the investment they're doing for robotaxi, for Optimus, and for the Cybercab, as well as doing data center and the semi-truck, they're going to spend $20 billion this year. And so they're going to have to pay for it. And the auto business and the energy business is where the cash comes from. They have $40 billion plus in cash. They're probably going to be a $2 billion cash drawdown this quarter. And a show me story. I agree with that. There's also so much going on right now with SpaceX, with XAI, and the possibility that they're going to come together at some point. And so there's a lot we could talk about.
Yeah, let's talk about that possibility that these two companies do come together. Let's say SpaceX goes public in June, so we're going to have to sort of, play this out a little bit. We don't know exactly what's going to happen. If that does happen, Ben, do you think that Tesla will become part of that Elon Musk company?
I think that I think so. I think that I mean, that it's better if they're both public companies to merge them together, just from a accounting standpoint, from both being public and having valuations. But they've already started, and going way back when, there were some shared employees between SpaceX and Tesla. But now you're starting to do like the terafab. You're doing this macro hard project, and so they're linking more and more together. And I think one big thing with Elon wanting to have ownership of over 25% or some kind of control that he said in the past with Tesla, that would also help him because he has a bigger share of SpaceX and XAI, that would also get him to that point as well. And it just makes sense from a scale perspective too, because this is a big arms race that we're in for AI, and speed to market, capital, very important right now. And so he knows that, and he's they're doing everything they can as fast as they can to do that race.
Ben, Craig also mentioned the idea of the cybercab, and that could bring some excitement to people. But I'm also wondering about other parts of the portfolio and what's in the pipeline, namely maybe a new SUV that has been bandied about a little bit. Is that something that moves the needle? And what can you tell us about timeline there and what that would do to the top line and the bottom line for the company?
Sure. Well, one thing that Craig said, and Craig said a lot of great things, but about just kind of like a tired brand of models, and the Model Y refresh. If you ride in it, it's a lot better than the original Model Y, and so they're not big changes. And the fact that they have just the Model Y and the Model 3 really main sellers. Versus other auto OEMs, they're more profitable on that, and they sell a lot of them because people like them. They're very good cars, and so it's good to expand if they have an SUV. Look, I have 6-year-old twins. I'd like to have a SUV as well. But I think that the real growth is winning this robotaxi war. And I don't know if it's a winner take all. I don't think so. I think that, but Tesla has the data. They have the scale. They have the service centers and the strategy. And it's going to be hard for others to compete and scale.
Ben Kallo of Baird. Ben, always good to check in with you. Appreciate you taking the time and joining us this morning on Bloomberg Tech. Well, coming up, NASA's Artemis II successfully launched. Now the crew's attention turns to firing off towards the moon. Details on that with Ed Ludlow next. This is Bloomberg Tech. NASA's Artemis II astronauts are in Earth orbit, and they're prepping for the next crucial step in their historic journey to the moon. They're going to fire the engines tonight to send them toward lunar orbit. With us now is Bloomberg Tech's own Ed Ludlow. Ed, just give us the latest when it comes to the mission status and what happens before tonight's big move.
Yeah, so the crew inside the Orion spacecraft are essentially in safe orbit. They conducted a burn this morning that took them from low Earth orbit to higher Earth orbit, and in a sort of elliptical fashion are going around the Earth until about 7 or 8 p.m. Eastern time. That's when the mission directors and flight directors have to decide if they are a go for the translunar injection, the burn that you described, which propels Orion the 250,000 miles or so to the far side or dark side of the moon. And that's why we're all here. That's the big part. And so there is risk, but there are testing systems. At some point, the crew has to sleep, but that's what we're tracking toward.
The dark side of the moon, the far side of the moon. What's back there?
Yeah, I mean, the point of the mission in part is observation of what's on the surface of the far side of the moon, right? This is a resources story. Water, minerals, oxygen. The value of the moon is in part strategic from that resources standpoint. There's also an important moment where the Orion capsule and spacecraft is going to lose contact with Houston and control. And you're all thinking, watching Bloomberg Tech, what? The crew, they're going to lose contact on the far side. Yeah, obviously. The moon's in the way. But that is also important, and they planned for that and prepared for that. And, it's going to be a really significant moment when, through what's called a free return trajectory, the moon's gravitational field and Earth's gravitational pull swings the Orion spacecraft back around in a figure eight and send it back to Earth. So there's risk here, but it is record-breaking in terms of what they're trying to achieve.
Well, we're talking about space, Ed. We've got to ask you a different question about orbit, and that has to do with shares of Globalstar. They're rallying today, up about 9%. This after we learned that Amazon is in talks for a buyout. Now, Apple owns about 20% of this company. What would this do for Amazon and its, quote-unquote competition for providing satellite service, web-based satellite service, or satellite web-based service for, and really competing with SpaceX?
It's interesting because the financial terms and what they're kind of agreeing to buy isn't disclosed. But what Globalstar has is very valuable licensed spectrum. That having Constellation in orbit is not really about the hardware that's up there, but the spectrum that it occupies. That's part one. The other part is that it's a kind of go-to-market story, right, where Globalstar is authorized and regulated in markets around the world. It has ground infrastructure corresponding to the Constellation-based infrastructure. That would help Amazon, with its own space-based internet ambitions, get into those markets, even if the satellites that are up there are about cell connectivity in places where terrestrial cell signal doesn't reach. That's all a big part of it. And you're right, the history of Globalstar is that right now that's how you get emergency messages on your iPhone or make emergency calls. But the bigger picture is just access to the space that's up there.
Bloomberg's Ed Ludlow live at Kennedy Space Center in Florida. Thanks, Ed. Well, the fintech company Chime is launching new checking accounts that offer cash back and other benefits as it steps up its challenge to traditional banks. Let's talk through it with Chime CEO Chris Britt. Chris, so-called Chime Prime, it seems like a departure from the core Chime product that appeals to people who don't necessarily care about Priority Pass or luxury hotels. Explain this strategic shift.
Well, we think it's a natural evolution for our company. And by the way, thanks for having me today, Tim. It's great to see you. We've already been come of age as America's choice for banking. And you've seen that in the data. J.D. Power for multiple quarters in a row now have reported that Chime's opened up more checking accounts than any brand in America, including some of these, the biggest incumbent banks in the world. So we think that the addition of Chime Prime is a natural addition for us. We've always done a really good job of cultivating primary direct deposit relationships with our members, people that are getting direct deposit and using Chime for their everyday transactions. What we realized is that we weren't doing enough to reward members who either had the capacity to or were already awarding us with large amounts of deposits. So with Chime Prime, if you give Chime a $3,000 total direct deposit over the course of a month, we unlock 5% cash back on the Chime card, which is a secured credit card. And you can choose the category that you get the 5% cash back in. So it could be groceries, restaurants, your monthly bills, you name it, but it's pretty powerful. I mean, if you think about a consumer who spends, say, $1,500 a month on groceries, we're talking about $75 of cash back in the month with this new product. So we're pretty excited about it, and we think it actually is a natural extension of our product suite.
Well, Chris, one of the reasons we like talking to you is because you have this great real-time view of what the consumer is doing and how the consumer is feeling. And I'm wondering, with higher energy prices and with savings not really there for a lot of Americans right now, how did they weather the last month?
Well, as we've reported the past few quarters, there's been certainly a lot of understandably uncertainty and some would say some doom and gloom as it relates to the state of the consumer. But as we've reported the past few quarters, we're seeing a steady, resilient consumer that continues to increase their spend across the categories of both discretionary and non-discretionary spend. We see saving account balances continue to stay at a high rate, and we haven't seen any uptick in unemployment. So I think across all of those areas, we see a healthy consumer. I would note that from February to March, we did see, not surprisingly, a pretty significant uptick in the amount that consumers are spending on their fuel purchases. So up over 25%, actually, month over month. So, that's definitely something that consumers are feeling a real pinch in.
Real quick, what were they spending less on as a result of spending more on fuel?
Well, we have not seen any sort of downdraft in spend at all. So we're continuing to see an uplift across all the regular sort of everyday categories.
Yeah.
About 70% of our spend is on non-discretionary. So that's one of the sort of really positive things about our business models, that whether the economy is sort of up or down, people are still buying groceries and paying their monthly bills and paying their mobile bill and all those sorts of things. So nothing's changed on that front.
I think it's fair to say that a lot of CEOs see this environment as a much friendlier regulatory environment in different industries. Why would you, a non-bank, still believe that not pursuing a bank charter is the best move in this environment?
Well, there's no question that the regulatory environment has loosened up a bit, and you can see it in all the quite a few number of applications to become a bank charter. We've certainly, that's something that we evaluate every year, and it's certainly an option that's on the table for us. But historically, when we've looked at how we've constructed this business, we think it's really been a win-win for Chime and our community bank partners that hold the deposits of our members in these FDIC insured accounts. It gives us the benefits of being a fintech that can move fast and innovate and really focus on our member needs, and have our bank, provide our members with all the security and protections of having your money safe in a bank account. Certainly as the market changes, we will reevaluate that, but we don't have any plans to announce in the short term on that front.
Chris, always good to see you. Chime CEO Chris Britt, thanks so much. Well, coming up next, a conversation with Stephanie Valdez-Streety of Cox Automotive as Tesla posts one of its worst sales quarters in years. That's next on Bloomberg Tech. Welcome back to Bloomberg Tech. I'm Tim Stenovec in New York. Let's take a look at markets with Bloomberg stocks reporter Natalia Kunijevic here in New York. Natalia, the NASDAQ 100 was down more than 2% earlier in the session. It's kind of flat right now. There was, about an hour ago, some news about potentially some discussions with Oman and Iran about the Strait of Hormuz. Is that what's driving markets right now?
It looks like yes. So we do see that major indexes are basically flat right now, but it's still a pretty defensive move. If we look at the sectors right now, real estate, utilities, consumer staples, so these are sectors that are moving higher today. So we got some headlines, yes, from Iran that is working on a draft of a protocol with Oman to oversee the Strait of Hormuz. However, when we look at the stock market, of course, we do see that the playbook is still really familiar. We see that stocks, since the beginning of the war in Iran, stocks are flat or up from Monday to Wednesday, and they are down on average from Thursday to Friday by about 9%. It tells us that investors don't want to hold positions going into a weekend because a lot can happen. And when I spoke with many traders or analysts, like what exactly you guys are doing, they said, yes, get rid of positions, go long on energy or, oil, gas, energy-related, commodities-related stocks, and, of course, sell economically sensitive stocks.
Especially out of a three-day weekend where the equity market isn't even open tomorrow, on a day where we are getting some jobs numbers for the month of March. You mentioned commodities. Let's talk oil real quick, because it does seem like the equity market is buying this, but it doesn't seem like the oil market is buying this, with Brent still up 6%, and wow, look at that, WTI up 10%.
Yes, 10%. So in terms of headlines, yes, Iran is working with Oman in terms of a protocol to oversee the Strait of Hormuz. Deputy Foreign Minister said that vessel traffic through the state should take place under Iran and Oman supervision and coordination. But of course, we also look at all global supplies in terms of oil and commodities. So for example, when we checked inventories in Egypt, which is also super important in terms of deliveries of Saudi Arabia crude to Europe. And now we see that those inventories are down by about 1 million barrels per day in the past 2 weeks. Just to compare, this is the equivalent of the growth in global oil demand that we projected before the war in Iran began.
Okay, Natalia Konijevich of Bloomberg News with a markets and oil update. Well, let's get to another big mover today. Tesla shares under pressure, down more than 4%. This after the EV maker posted one of its worst sales quarters in years, missing Wall Street expectations. Stephanie Valdez-Streety is Director of Industry Insights for Cox Automotive, and she joins us now. Stephanie, I want to start off where we left off with Natalia, and that's with higher energy prices. Do you see this increase in energy prices, this substantial increase, the more that Americans are spending and the more that people around the world are spending on oil, as something that can actually push people to buy more Teslas?
Yeah, I think definitely like it's causing the conversation to come up, but I don't think that consumers will immediately go out and buy an EV. I think what it does do is have them start, if they earn the market for a vehicle, start to consider more fuel efficient vehicles, which an EV is part of that conversation. But I think these high gas prices would have to stay prolonged for consumer behavior to really change, but definitely impacting consideration.
How long and how high?
I think 6 months to a year. I think consumers are just kind of waiting it out. But I want to take a step back and just look at the broader economy. I think as gas prices go up, consumer sentiment goes down, and that leads to consumer spending going down, especially for a high ticket vehicle like a car. So I think consumers are just going to wait in general to buy a vehicle, whether it's an EV or an ICE, just because of the current economic situation.
Yeah, I mean, especially such a big purchase like an auto, whether it is an electric car or an internal combustion one. I want to go back to Tesla and this miss when it comes to deliveries. Analysts, got it wrong, but they weren't expecting a great quarter. Where's the biggest opportunity for Tesla right now? Is it in the U.S. or is it outside of the U.S., where I think many analysts would argue it faces even more competition, particularly from China?
I think in the U.S., there's competition. They have basically the Model Y and Model 3, right? That's the mature vehicles, no fresh product. They have a lot more competition in the U.S. And then in addition, right, the regulatory changes. The IRA is gone. And so that's really impeding sales across the landscape for EVs. And then you mentioned globally, right? China. I think that's a challenger to everyone, not only Tesla. So I think for Tesla, it's really, I think for their product, it's like repositioning it, really focusing on affordability, product freshness. And I think with their infrastructure and battery tech, I think highlighting some of that and really having targeted marketing for that, I think might help a little bit.
If you think about it just from the perspective of outside the U.S. and some of the European countries and some of the Asian countries, of course, where it does face competition from what many analysts would say are better and even less expensive cars from the likes of BYD and Xiaomi. Right. How does Tesla position itself against those competitors?
I think it needs to continue to have vertical integration. I think they need to continue to do that. But I think at the end of the day, if they want to continue to defend market share within the auto sector, they need new product. Customers like newness, right? And they haven't had any of that other than the Cybertruck, which is really niche. And so I think for them to compete globally, having new product is key.
What kind of new product? I mean, Craig Trudell covers autos globally for Bloomberg, talked about the Cybercab, but what else?
I think more affordable, right? Affordability is the key thing, whether it's US globally. And so having an affordable EV that they, had talked about a couple of years ago, but never came to fruition. So I think having an affordable option for consumers, that's the biggest barrier right now for EV adoption is the price points. I think 65% of product in the US are above $65,000. That really pushes out many households. So I think for Tesla, if they can have an affordable EV launch, that could really help.
But the challenge with that is, at least here in the US, you don't necessarily have the credits that Tesla was used to and Tesla investors were used to for years because of the lack of support from this current administration for EVs. Can Tesla get prices down without government intervention?
Usually it's the battery, right? The battery's up to 40% the cost of the vehicle. So it's continuing to innovate on battery production, chemistry, and even within the manufacturing process itself, trying to come up with more efficiencies to reduce that overall cost. And I think going back to the, whether it's tariffs or gas prices, logistics, it all adds up to, it has that multiplier effect, which could impact the overall cost of operations and manufacturing. So there's a lot of headwinds.
Yeah, Tesla shares
coming their way.
Yeah, well, the investors facing some headwinds in the long term, and even today with Tesla shares down about 4%. Stephanie Valdez-Streety of Cox Automotive. Thanks, Stephanie. Appreciate it. Well, let's take a look at shares of Blue Owl Capital, which will limit redemptions from 2 of its private credit funds after facing an unprecedented surge in withdrawal requests. Shares under pressure right now, though, off their worst levels of the day, down about 1.2%. Investors have grown skittish about private credit after some high-profile collapses and concerns over AI disrupting software companies that relied heavily on direct lenders. Coming up next, Kyndryl CEO Martin Schroeter joins us to discuss how he plans on helping companies scale up in the age of agentic AI. That's next on Bloomberg Tech. The release of the source code for Anthropic's hit programming tool, Claude Code, was, quote, absolutely not a breach. That's according to the company's chief commercial officer, Paul Smith. Smith blamed the incident, which exposed some unreleased features on, quote, process errors. Let's get to the latest with Bloomberg's AI reporter, Shireen Ghaffari. Shireen, you and the team have been covering this really closely. What did you learn from this Anthropic executive?
Sounds like it was, as he said, not a hack, but a human error, that the company is moving very quickly to release new features, which has been their strength, and that they've been able to get ahead and close in on competition by having this succession of features rolling out. But when things move that fast, it also leaves room for error, as we saw with the release of thousands of lines of code that the company is now trying to contain.
What did it expose exactly, and what are the risks of that exposure? Like, why is the company, what specifically is the company trying to contain as a result of this?
So what was released was source code, which is just the underlying code for their very hit product, Claude Code, which is a coding agent. Now, that's not the only part that goes into a model's secret recipe. There are other layers on top of that that are not out there. However, that source code is still valuable, is something that now is in the ether and hard to sort of put back in the bag.
Can competitors actually do something with this?
Well, Anthropic has issued takedown requests to people who are distributing this code, and so there are potential ways that they could try to stop that legally. However, again, when something's out there, especially if you take code and then, let's say, change that code or tweak it, it becomes a little harder to contain.
All right, Bloomberg Shireen Ghaffari. Follow her for the latest at the Bloomberg Terminal, and of course also at Bloomberg.com. Well, Alibaba has unveiled its third closed-source AI model in as many days. Chinese tech firms have typically taken an open sources approach, but the proprietary models allow the company to charge more directly for its tools. The Chinese tech giant is keen to monetize its growing AI portfolio, in part to counter weakness in its e-commerce business. And most businesses in the US run on a tech infrastructure built for another era, but not for AI agents. Kyndryl is trying to change that. Today, the enterprise tech services provider announced the launch of its Agentic service management to help companies scale and get actual return on AI investment. Kyndryl CEO Martin Schroeder joins us now in New York to explain more. Martin, good to have you on the program. How do you know that this is the right way to invest? Like, how do you know that AI agents are what we should be betting on and what you should be betting on right now?
Well, we're using it in real time already. We use agents across our infrastructure to help our customers achieve their business objectives. We are the world's largest IT infrastructure services provider, so tens of millions of people, hundreds of millions of people every day are relying on the banks that we help. We help over half the world's largest banks run their systems. We help 8 of the 10 largest airlines. We help the industrial base that makes most of the world's cars, so healthcare companies. So what we already see today is the technology is very robust, but it also needs to be controlled and managed properly. And that's really what Agentic Service Management's and our announcement today is all about. How do we help our customers deploy Agentic to get the benefits from it at scale while still being able to control it and make sure it's secure and performing the things that you're expecting it to perform?
Everyone's trying to figure out what the benefits of this technology is actually going to be. You see it, day in and day out when you're talking to customers. How are they using it right now, and what's the return on the investment that they're getting?
So the return on investment, which I'm sure you've seen as well, is sort of it's sort of very disparate. So many of our customers are seeing great returns on using productivity from AI and within their employee bases. We see that as well. Our own employee base now, as we sit here today, has already created nearly 25,000 agents that they use to be more productive in their jobs. So our customers are seeing some of that. At the other end of the scale, many customers are struggling to get AI to scale properly. As you said well in your intro, the world's infrastructure was built for a different time and probably not really ready yet for agentic AI. It's like building a brand new bullet train that can go 200 miles an hour, but still running on tracks that were built for 30 miles an hour. And that's where Agentic Service Management comes in to give you that control plane to allow you to start to modernize your systems.
You have a great view on what these firms are spending when it comes to enterprise tech, when it comes to this technology. Just the climate out there right now, with the volatility that we've seen this year, particularly in the last month with the US and Israeli war on Iran, are you seeing any change in spending? Is that market, is that customer base pretty resilient?
Well, the customer base, particularly for the work we do, which is mission critical, right? The hearts and lungs of these firms, it is pretty stable. I'd also say that, look, the situation in the Middle East is creating slight shifts, making sure that you have resiliency in those operations. But we also see some other what I'll call longer term arcs that are important. Data sovereignty is top of mind for everybody today, and we have obviously a point of view on that. We're helping customers think about data sovereignty. So in the mission critical world, the issues of security and resilience, the issues of modernization, they're pretty stable. It's a growing market, and I don't expect to see massive shifts based on whatever's in the news.
But on budgets, there's sort of a more fundamental question, and that's about the spend when it comes to what these companies are actually buying and purchasing right now. And a lot of that in really recent months and even in the recent last year has really shifted toward AI. How do you convince them to spend on infrastructure, or maybe tie that infrastructure spend to the AI story that's happening right now?
So we're in the business of creating productivity for our customers, right? And the way we get to growth is by creating productivity in order to create pools of money that they can go invest in whatever is sort of top of mind. And you said it well, AI has been top of mind. But again, when you have disruption in the world and geopolitics playing a role, it may be resiliency, it may be data sovereignty, it may be trying to rebalance your work to a private cloud versus a public cloud. So the nature of what we do has always been about drive productivity for our customers, do what they're doing more efficiently, create a pool of money, and then help them invest where they want to be.
On agentic AI, we hear from people all the time who say we're all going to have our own AI agents, and in a really short time, and the AI agents are already out there acting on behalf of some people who are sort of early adopters. Is that a view that you agree with?
I think that each of us, I mean, I have agents that do automated work for me, right? But it's very much a productivity tool. I will tell you.
But you're here with me in person.
I will tell you that in the infrastructure we run for our customers, in the production workloads, we have, as we sit here right now, 920 trusted proprietary agents doing the work that helps us run the infrastructure. Compare that to, again, our employee pool is created to just under 25,000 agents. So yes, there is a proliferation of agents in the productivity space that is going to continue, but agents doing real running production systems for companies, for the kinds of companies we work, that's at about a 20th of what the others are. Now that's going to grow fast. It's going to grow fast because they're very effective. They allow us to deliver higher quality. They do save money, but it is going to take a while to get into the production environments.
Martin, before we go, I'd be remiss if I didn't ask about the volatile year that Kyndryl has had and the leadership changes, the CFO leaving, some accounting disclosure issues that certainly spooked the market. Given those hiccups, what can you say to investors right now that midterm revenue, profit, and cash flow goals remain within reach?
Yeah, so we did have a material weakness that we disclosed. We also are cooperating with the SEC to try to get through the issues and the questions they have around disclosure. Keep in mind there was no financial restatement, right? So the financial position of the firm is the financial position of the firm, and we will this year continue to make progress toward 28, and we still see 28 as a year where, relative to what we talked about almost 2 years ago now, we'll be able to triple cash flow and double profits on our way to sustainable revenue growth.
Kyndryl CEO Martin Schroeter, thanks so much for joining us on Bloomberg. Well, the tech sector's job purge is continuing to rise. New data from Challenger, Gray & Christmas shows that layoffs in tech companies topped 18,000, up more than 24% from March of 2025. AI accounted for a quarter of the 60,620 total job cuts last month, as companies such as Meta and Oracle shift budgets toward AI investment. Coming up next, Microsoft CFO Amy Hood has one of the toughest jobs in big tech. We're going to explain why next. This is Bloomberg. Microsoft CFO Amy Hood has the toughest job when it comes to navigating internal tensions and financial discipline. While competitors such as Meta, Google, and Amazon are spending tens of billions of dollars without hesitation, Hood has maintained a reputation for extreme accountability. Let's bring in Bloomberg's Brody Ford in San Francisco, who has more. He's the author of today's Big Take about the Microsoft CFO. Brody, why is her job particularly more difficult than some CFOs at other publicly held tech companies?
Well, we talk about it on the show every day. Like, the big question in the economy right now is, are these huge data centers going to pay off? And so Amy Hood at Microsoft is sitting on kind of a nation state size level of investment, and she has to figure out, how much do you give to data centers? How much do you allocate to internal teams or OpenAI or other customers? And so essentially, she is having a very big job beyond the scope of what you would think of as a CFO. And, you know, every 6 months to a year, the market has a different feeling on whether these data centers will pay off. And she's the one on the day-to-day within Microsoft determining what's the right amount of money to spend.
This is a great deep dive on her history. She's been at the company she's been at CFO since 2013. She was at Goldman Sachs earlier in her career. Give us an example of a time where she was right about financial discipline when others really thought they should be spending more money on certain products.
Well, the big thing right now is that she is skeptical of straight up renting out the servers to AI customers, right? You think about the big Oracle deal that vaulted their stock late last year with OpenAI, that $300 billion booking. That contract was on Amy Hood's desk. They had the option to take it, and she said no. And when Oracle first signed that deal, it seemed like a coup. It seemed like, man, you know, Larry Ellison was having his comeback. And within a couple of months, it started seeming much more like a burden, and maybe Amy Hood had dodged a bullet. The jury is still out on a lot of this stuff and how the AI era will look. But at this point, it seems like she has made a shrewd choice.
Bloomberg's Brody Ford. Check out his Big Take, written along with Matt Day of Bloomberg News, on the Bloomberg Terminal and at Bloomberg.com. That is going to do it for this edition of Bloomberg Tech. Do not forget to check out our podcast. You can find it on the terminal, as well as online at Apple, Spotify, and iHeart. This is Bloomberg.